Namaskar and welcome to this course once again on Introduction to Accounting and Finance for Civil Engineers, which I am offering with my colleague Professor Jha in IIT Delhi. Now coming to this lecture, we will continue our discussion on construction projects and what makes them so special. Now in the last class, when we had talked of general issues in construction projects, we had learned the concept of the cash flow diagram, the inflow and the outflow of money, whether it is for the contractor or the client, and its importance from the point of view of planning as far as a construction project is concerned. Then we had learned that the project and therefore the related transactions could span for several financial years or terms, and that makes it interesting to figure out how the account books for that period will be maintained. Also, we discussed the situation that a company could have different projects going on, and they may all be at different stages of completion at a given point in time. And from those various projects, there could be receipts as far as running bills is concerned and expenditures being incurred in different projects. Now, how should that income and expenditure reflect as far as the financial statements of that company is concerned for a given financial year? And of course, we must remember that the financial statements cannot and possibly should not be made on the basis of incomplete information. And when it comes to a project which is ongoing, whatever is coming in, whatever is going out, to that extent is not a complete information, because those things are all subject to change, and that is what the spirit of a running account bill is, that it is subject to further verifications, changes and so on. Of course, we try to avoid those changes to the extent possible, but at the end of it, in a financial sense, the matter is not closed. So that is what we had done in the last class. So coming to our discussion today, I will recall again from the last class that what we had said was that the idea of using this, that is the last class, and possibly the next one, which is this one, we will discuss general issues in construction projects, and we will pose certain questions from real life projects to basically have a certain reorientation as far as you are concerned and see how a construction project can be looked at. So what we will do today is we will continue our theme of generic issues which make the construction projects special, and the discussion will be largely focused on some aspects relating to procurement and management of construction equipment. This, let me emphasize, is a very important aspect of modern construction projects, where mechanization is a very, very important part of the construction works. Now let us consider the purchase and operation of a construction equipment by a contracting company. What we must remember when we talk of construction equipment is that they are very expensive. It is not a very small purchase. Most of these construction equipments involve an investment where we expect certain returns, and therefore the companies have to be very careful. They have to go through a lot of process before they go ahead and buy an equipment. Then, as far as the operation of these construction equipment is concerned, it involves continuous expenditure. That is, it could be purely operational. Whatever equipment you use, it will consume some fuel, it will consume some manpower, and that expenditure is incurred all the time, so long as the equipment is being used. So apart from this purely operational expenses, there are inspection and maintenance expenses for these equipment, which could be by way of spare parts, manpower involved in the inspection and maintenance of these equipment. And this inspection and maintenance, as far as the construction equipment is concerned, could be periodic, it could be emergency. So one example that I can give you as far as this part is concerned is that if you think in terms of the car that you buy and the car that you operate. You have a car, you have bought a car, you have invested certain amount of money, and then if you do not run the car, there is no expense. But if you run the car, there is a fuel expenditure. If you have a driver who runs the car, you have the salary and so on and so forth. And then periodically you have to make sure that the car is in running condition. That is, there are certain parts in the car which need periodic replacement, they need periodic inspection. Then there may be at times emergency inspections and emergency repairs that have to be carried out. That is how we look at the different expenses associated with construction equipment as well. There are purely operational expenses, there are inspection and maintenance expenses, periodic, emergency and so on. Apart from this, we must remember that construction equipment have a finite life, and after that they need to be scrapped and replaced. Now, when it comes to scrapping and replacing these equipment, we must remember that we need to address the question, is there any salvage value? Does the scrap have any value? And then how do we replace the equipment? When do we replace the equipment? How do we get the resources to replace the equipment? These are the kind of questions that we need to address as well. Further, we have to remember that an equipment may be used in different projects over its service life. So, in the previous discussion here, when we were talking of a finite life, we remember that the equipment over its service life, and this service life is this finite life that we are talking about. So, during this service life of the equipment could be used in different projects. The question that we have to answer is that if the equipment, let us say, costs 10 crores, how do we apportion the 10 crores in the different projects that it works in? So, these are some of the questions that we need to answer and discuss in a generic sense, and then of course, we will get into more specific details in subsequent lectures. So, coming to the first part, that is the investment involved in the procurement of these equipment and the operational expenses, whether they are purely operational or its inspection and maintenance. What it boils down to is that we should be able to generate and evaluate options. There could be different equipments in the market which are available. We have to have a methodology by which we are able to reduce the kind of information available for different equipments in a manner that the two equipments can be compared and an appropriate decision taken so that it is the best for the company. We must remember that as far as the investments are concerned by construction companies, those companies are responsible to their shareholders as far as the purchases are concerned. Somebody can question them that, okay, why did you invest in a 100 crore equipment or a 5 crore equipment when you knew that it is going to last only 2 years, and so on and so forth. So, there has to be a transparency, there is the process of accountability, and therefore, companies have to be sure that the investments that they are making are defensible. They can be defended to the shareholders. So, from that point of view, we will talk in this course about how to generate these options and how to evaluate them. When it comes to this question of finite life, after which they have to be scrapped and replaced, what we must remember therefore is that apart from the initial value, so apart from the initial investment that we make in the equipment, that is the purchase or the cost, there is a service life, there is a scrap value, and there is depreciation. Depreciation is nothing but the change in the value of that equipment as time proceeds. An equipment which has a value something like this, which is the initial value, after its service life has only what can be called the scrap value. So, this change in value here is the total depreciation that has occurred as far as that equipment is concerned. Whether this depreciation occurs linearly or not so linearly, that is something which we will talk about later, but what this line or this curve would show is that what is the value of this equipment at different points in time. So, this is something which we need to address. What it means therefore is that for any equipment we can define a certain amount of depreciation in value every year. So, if it was a linear case, we say that okay, over this period of time, this is the amount of depreciation that has happened. Over this period of time, this is the amount of depreciation that has happened. Whether these two things are equal or not is a different matter. That would depend on whether we are taking linear depreciation or not, but the fact is that yes, there is a change in value over time, and that is something which has to be accounted for and addressed when we are trying to generate and evaluate options as far as equipments are concerned. Now, when it comes to the issue of equipments being used in different projects over their service life, then we should remember that there are expenses that are involved continuously. let us say this is the service life of the equipment. For this period it is used in project 1, this period it is used in project 2, this period it is used in project 3, and it may continue to be used even beyond that point in time. But that is something which we will talk about separately. But the fact of interest right now is that if this equipment is used in these 3 projects over its service life itself, that is, during this period its value is changing from an initial value to its scrap value. And whatever depreciation is happening, what we have to determine is how much is the cost of this equipment to be charged to the project, whether it is 1, 2 or 3. So, what I am saying basically is that from a project what should be charged as far as the fees or as far as the cost of using this equipment is concerned. So, the first thing is that the operational costs, whether it is purely operational or its inspection and maintenance, all that cost must be charged to individual projects wherever the equipment is being used. And then as far as the initial value of the equipment is concerned, that can be charged in a manner that only the depreciation towards the equipment cost while it is being used in a particular project may be charged towards the equipment cost as far as a particular equipment is concerned. So, going back to this particular example, if in this project this is the amount of depreciation that happened, this amount should be charged to project 1, this amount should be charged to project 2, and the remaining amount here, this is the amount that should be charged to project 3. This is as far as this part is concerned, and as far as the operational expenses are concerned, for each of these projects they have to be charged in full. So, that is how we can charge different projects for using the equipment. That has to be built into the cost of those projects. When we say as a construction company that we take up this project or this project or this project for a certain amount of money, what that amount must include is these kind of things altogether. For all the equipment, full expenses as far as the operational costs are concerned, and the sum of all the depreciations that occurs at that project site. So, that is how we work as far as estimating the machine cost is concerned for the project cost. Now, moving forward, continuing with the discussion of construction equipment, which is obviously an asset as far as the company is concerned, and the technical definition of an asset is something which we will do much later. We also need to answer questions such as how and when does a company decide to buy an equipment? Can there be policy or regulatory provisions to encourage companies to invest in equipment? And is the equipment base, which is the assets in the form of the equipment, a measure of the technical soundness of a company? Now, let us try to answer these questions one by one. The first question is, how does a company decide to buy an equipment? This question I am not going to discuss right now, it will be answered when we try to talk about replacement analysis in greater detail. You would recall that that is something which Professor Jha had talked about very briefly when we were doing the first lecture and we were trying to introduce the whole course to you. Now, as far as the second question is concerned, can there be a policy or regulatory provision to encourage investment in equipment? Now, as far as this question is concerned, let us have some kind of basic discussion. It is not drawn from actual provisions, but it is laid down here to give you an idea as to how policy and regulatory provisions help in encouraging companies to build an equipment base. Let us consider how taxation and equipment purchase could be related. Tax laws impose taxes on companies on the basis of the annual income generated through conducting the business, and certain provisions in these laws can incentivize equipment purchase. How does it work? Let us take an illustrative example which is given here. Assume that there is a clause in tax rules that states that expenses for acquiring capital assets. Now, we are using the term capital assets, and construction equipment is very much a part of capital assets. If the tax provisions state that as far as acquiring capital assets is concerned, 50% of the value of the asset, or let us say 50,000 rupees, whichever is lower is deductible for calculation of taxable income. What it operationally means is that if there is a company which has a gross income of let us say 5 lakhs and these provisions were applicable, and the tax rate is a flat 25% of the taxable income. I will draw your attention to the use of the word taxable income. This is different from gross income. So, there is a gross income that the company has, and from that what we have to determine is whether this gross income is simply equal to taxable income or not. Now, if it is equal to taxable income, then there is no discussion, but most of the time there are certain deductions which are allowed before the taxable income is calculated. So, now as far as acquisition of assets is concerned, if these were the kind of provisions which were available, that 50% of the value of the asset or 50,000 rupees, whichever is lower, is deductible for calculation of taxable income from the gross income, and this was the data, then how does the tax liability change? So, in the first case, if there is no equipment procured, the gross income is, let us say, 5 lakhs, you have not done anything here. So, your net income as far as taxable income is concerned is the same, and therefore, the tax payable is 25% of this amount, which is 125,000. Now, however, if you have acquired or the company has acquired an asset worth 1 lakh, which is what was stated in the previous slide. So, now 50% of this, which is 50,000, or the absolute value of 50,000. So, in this case the numbers are such that these two numbers match. This is what is deductible from the gross income before you calculate the taxable income, which means that an amount of 50,000 can be removed from here and your net taxable income becomes 4,50,000 and the tax payable is 112,500 rupees, which is 12,500 lower than what you were paying if you had not bought any equipment. So, what it says is that there is a clear saving of 12,500 and effectively the equipment cost is reduced by this amount, because this amount would not have remained with you anyway. So, this asset which you bought, which was for 100,000, it has actually cost you only 87,500, because this 12,500 is something which you have saved as far as taxation is concerned. So, this is one way of looking at how taxation provisions could incentivize equipment purchase. Taking another example, if for example depreciation expenses are fully deductible from gross income, if there was another provision like this and the income tax slab is again 25% as in the previous example, and we have a situation where by use of equipment there is an expenditure of 80,000 towards depreciation of already existing assets, how does that change the taxable income and the taxation? For that, obviously, if you do not have any depreciation expenses and given the fact that we are still working with a 5 lakh gross income, and that is the example that we took earlier, the taxable income remains the same and the tax liability or the tax payable is 125,000 without any change. However, if we have a situation where there is an 80,000 which is admissible as far as depreciation expenses are concerned, then the net taxable income becomes only 4,20,000 and the tax payable is 105,000 as against 125, which means that you are saving 20,000 because of booking 80,000 as far as your depreciation expenses are concerned. Now, this actually is something which we will discuss in greater detail when we do depreciation of equipment, because the companies could be interested in enhancing the depreciation rates at a given point in time, so that they can book more and more expenses as depreciation expenses. And that is where I would like you to recall that what we had said was linear depreciation, and that is the simplest model to work with, is not necessarily what is the best model as far as companies are concerned. They may be interested in a situation where instead of the depreciation being equally distributed over the service life, they may like that in the initial part of the use of that equipment, the depreciation expenses are more. That is, more expenses are admissible as depreciation expenses than later, even though the initial value and the salvage value, these do not necessarily change. So, but that is something which we will come to later. As far as this class is concerned, sufficient to understand that there are provisions or there could be provisions which enable companies to log in depreciation expenses, purchase of equipment expenses and thereby reduce their taxes. Please understand that that does not mean that they are dishonest as far as tax payments are concerned. It is the provisions that exist, and those provisions are being used to create assets. So, therefore, if there are provisions socially and legally which allow companies to invest as far as equipments are concerned, as far as their maintenance is concerned, that is a perfectly legitimate way of doing business. So, companies often use this approach to reduce the taxable income. Now, coming to the last of these three questions, is the equipment base, that is assets in the form of equipment, a measure of the technical soundness of a company? To that, even though the obvious answer is yes, it needs to be borne in mind that a company could have lots of equipment with varying initial costs, dates of purchase and service lives. And then how do we calculate the equipment base of a company at a given point in time? The principle could be to use the sum of the book values of the equipment as a measure of the company's equipment base. The term here is book values. That means there is something like a book value of every equipment, and that book value is something which you arrive at by removing all the depreciation that has occurred as far as that equipment is concerned from the initial value of the equipment. And this discussion we will repeat and do with a little more rigor when we discuss this issue of depreciation in a subsequent lecture. Now, coming to an end as far as this lecture is concerned, let me close by saying that what we have done today is discussed different aspects of equipment procurement and relevant bookkeeping issues such as depreciation, policy and regulatory incentives for equipment procurement. And beginning with the next class, we will get started with the basis of economic decision making, and to begin with, we will take a close look once again at the cash flow diagram and look at some very interesting dimensions of that diagram. We will also look at the concept of time value of money in that sense and see some of the ready-made formulations that are available which make our jobs of computation easier. And with that, we come to an end of our discussion today. Thank you, and I look forward to seeing you in a subsequent discussion.